Welcome back to Outside the Dollar. I'm Elena Reyes. So June's inflation report came in cooler than expected, and gold rallied more than 2% on that news, with traders pulling back their bets on an immediate Fed rate hike. At the same time, oil is climbing on fresh U.S. Iran tension. U.S. debt just crossed $39 trillion, and India and China keep trimming their Treasury holdings while stacking more gold. Two very different stories, one backward-looking, one forward-looking, and today I want to hold them side by side. We'll get into what financial repression actually means, where that term came from after World War II, and why it's showing up in conversations about this debt load again. I'll also walk through the mechanics behind gold's move this week against the oil and dollar risks sitting underneath. Then we'll look at India's Treasury holdings, now at a 6-year low, and ask whether this is really sovereign diversification or something bigger. And I'll close with a producer price number, the Fed's late July meeting, and one bank's $5,000 gold call. Let's start with that inflation print and what it does and doesn't tell us. Let's start with a number that surprised a lot of desks this week. June CPI came in at 3.5% year-over-year, below what Wall Street expected. Josh Jamner at ClearBridge Investments told Investment News that underneath the hood, inflation was fairly muted, and gold moved on it. CNBC reported spot gold jumped 1.2% to $4,046.64 an ounce, bouncing off a 2-week low in that same session. So why did a cooler inflation print push gold higher instead of lower? Think about it this way. Softer CPI means less pressure on the Fed to hike, and gold tends to like that environment. But here's what nags at me. CPI measures what already happened. It's a rearview mirror. CNBC's same report flagged something moving in real time. Oil prices climbing on renewed U.S. Iran tensions. Americans are now weighing two competing forces, softer inflation data behind us and an energy shock that hasn't fully worked through the numbers yet. Oil doesn't stay contained. It works into transportation costs, food prices, shipping, utility bills, with a lag. So the CPI report we're celebrating today might be measuring a world that's already changing underneath it. And that's just one thread. Zoom out further. The FX Street piece I read this morning pegs U.S. federal debt above $39 trillion. Add to that, Times of India reported gold has actually surpassed U.S. Treasuries as the world's largest reserve asset, with India and China both trimming their U.S. Treasury holdings while stacking gold instead. So which is it? Is this cooling inflation report a real turning point, or just a pause before oil works its way through the system? I can't answer that from one data print. What I want to figure out is why $39 trillion in debt keeps showing up in every one of these conversations, and what it actually does to the money sitting in your pocket. Building on that, what does $39 trillion in federal debt actually do to money over time? Let's think about this practically. You can't tax or cut your way out of a debt that size without political pain nobody in Washington wants to own. So governments have historically reached for a quieter tool. It's called financial repression. In plain terms, you hold interest rates below the inflation rate, so the debt shrinks in real terms, even while the number on paper stays exactly the same. The U.S. used this playbook after World War II. Debt relative to the economy was over 100%, and rather than default, policymakers kept rates capped while inflation ran hot for years. The debt didn't disappear. It got smaller in real terms, quietly, 1 year at a time. Who pays for that? Savers. If your account earns 2% and inflation runs at the 3.5% June CPI print settled at, you're losing purchasing power every year, even as your balance keeps growing on paper. FX Street published a piece making the case that the U.S. can't default on debt this large, and that financial repression is already underway. I'd frame that a little more carefully. It's less a certainty, more a pattern that keeps repeating through history. And some governments aren't waiting to test that theory. Times of India reported that gold has now overtaken U.S. Treasuries as the world's largest reserve asset, with India and China both trimming their U.S. Treasury holdings and building gold reserves instead. Does that make sense as a signal? Central banks aren't making a moral judgment about the dollar, they're weighing the same trade-off households face: real returns against paper promises. To put this in perspective, none of this makes gold the fix. It's one asset people research precisely because it doesn't carry an interest rate that can be held below inflation. That's a structural difference, not a guarantee. Worth sitting with on your own. If rates stay below inflation for years, what's actually happening to the cash sitting in your savings account? And speaking of rates moving prices in real time, gold's move this week gives us a live look at that exact mechanic in action. Building on that trade-off, let's look at what gold actually did this week. Spot gold climbed more than 2% off Tuesday's two-week low, CNBC reported. That's a real move, not noise. Now, shift from Washington's debt math to the buyers on the other side of that trade. Who's actually stepping back from Treasuries right now? The Times of India ran a piece on this, and the number that jumped out at me was India's Treasury holdings, down to a 6-year low. China's cut its position substantially too. So where's that money going? Largely into gold. The same article notes gold has actually surpassed U.S. Treasuries to become the world's largest reserve asset, something bullion prices climbing over recent years helped drive. Now, before anyone reads that as a dollar exit, slow down. This is diversification, not abandonment. India and China still hold enormous dollar-denominated assets. Nobody's dumping the currency overnight. But think about it from a central bank's chair for a second. If you're managing reserves for 1 billion-plus people and you're watching debt levels and financial repression debates play out in the country whose bonds you're holding, what do? You hedge, gradually, quietly, over years, not headlines. That's the piece connecting back to everything we've covered: the debt, the repression risk, the reserve shift. Sovereign buyers are managing the exact same trade-off households are. How much currency risk am I willing to hold? And when the two largest emerging economies on Earth are both trimming treasuries while stacking gold, that's not noise. It's a trend worth watching, even if it's moving at a diplomatic pace rather than a market crash pace. Which brings us to the numbers that came out this week, because the inflation and production data tie a story that ties all of this together. Shifting to the numbers that got buried this week, producer prices. Lear Capital's rundown showed producer prices fell 0.3% in June, the biggest monthly drop since April of 2025. May got revised down too, from a 1.1% gain to just 0.6%. Wholesale energy and gasoline prices did most of the falling. But zoom out to the annual number, and PPI still ran 5.5% higher year over year. Which read do you trust, the monthly dip or the yearly trend? Now, there's a catch. Lear Capital also flagged renewed U.S. Iran tensions, pushing oil back up, right as June's progress showed in the data. If oil keeps climbing, does that cooler print survive into July's report? An open question, not a settled one. The Fed meets July 28th and 29th, and most expect a hold. Softer inflation gives them room. Rising oil takes it away. Citi has put out a projection that gold could reach $5,000 within 6 to 12 months. So here's what I'd watch, not predict. Track oil and rate expectations together. Don't lean on inflation data alone. It tells you where we've been, not where debt and central bank buying take us next. So where does that leave us? Inflation cooled, gold bounced, but the bigger questions didn't go anywhere. oil risk, that $39 trillion in debt, the reserve shift we talked about with India and China, none of that resolves in one soft CPI print. Here's the honest takeaway. Nobody knows exactly how this plays out. What some Americans are doing is adding physical gold and silver into a diversified, long-term strategy. Worth researching yourself before you decide anything. If you found this useful, subscribe and leave a review. It genuinely helps the show. To learn more about physical gold and silver or adding precious metals to an IRA, text $$ to 43343 for your free investor kit. That's $$ to 43343. Thanks for listening.